Okay. Very good morning, everyone. All right. Audible and visible? Thank you. Thank you so much. Okay. So, I hope you all are doing good. And not only we are doing good, RBI has done something really unexpected. So, today we'll be taking this editorial or this news. It is everywhere in the newspapers. So, all today's newspapers are flooded with this information, right? Hello, good morning everyone. So, we'll try to dig deeper into this information and just stay tuned. After this analysis of this entire news, what is it, what will be its benefit, what is the behind picture or the backdrop of this decision, everything else, after this analysis you will know everything about what is a surplus transfer, how RBI does it, why RBI does it, why it has increased it so much, right? All your questions will be answered, right? So just stay tuned and let's get started. Okay, so here is your news that says RBI to extend rupees 2.1 trillion for financial year 2024, right? As you all know that there is something called surplus, right? Something called surplus when there is excess of income over expenditure. Are you getting my point? When there is excess of income over expenditure. So this surplus or the profit, extra profit, not the entire profit, but the surplus profit of the RBI is transferred to the government of India, right? Why the RBI has to do that? Because of section 47 of RBI Act 1934. We'll look into it. So news is that RBI to pay record 2.1 trillion for financial year 2024. So every year RBI transfers this surplus amount to Government of India. Why is this so much gaining so much news and limelight this year? Because of this huge amount of transfer, 2.1 trillion rupees. This is very substantial, right? Even it is far more than what the government has expected in the interim budget presented this year. Are you getting my point? So this is the headline. Let's understand what is it all about. And it is written that it will be a windfall for the government. Yes. What is windfall? Windfall is an unexpected gain, or when you receive something unexpected money, right? So let's see how does it come out to be a windfall, right? Isn't it transferred as per economic capital framework? Yes, it is calculated as per economic capital framework. We'll do everything. Don't worry, don't rush. I have written everything in this PPT for you, every term which is there relevant for you, right? And it is transferred as per the legal framework of RBI Act. So section 47 requires the RBI to do that. Okay, the economic capital framework is just a method of calculating it. All right, so let's see how it undergoes. Don't worry, everything will be covered. Now, so this is your news that the RBI's central board met on Wednesday. So the meeting was held yesterday only, and the central board decided to transfer a record surplus. So it is a record because history has been created, right? This is something which has not been disbursed so far, right? So transfer of a record surplus of 2.11 trillion to the government for financial year 2024. 2.1 trillion for the government, 2.11 trillion to the government for 2023-2024, even after increasing the contingent buffer at peak level of 6.5%. So we'll understand what is this contingent buffer. So the news here is, just try to understand that RBI is required, according to Bimal Jalan committee, RBI is required to maintain a contingency buffer as well. What is a contingency buffer? Contingency means emergency. You all know that the central bank has to keep emergency funds, right? In order to have banking, in order to have the Indian banking system secured in any kind of stress or risk. So the committee has recently revised this norm and requires the RBI to keep a contingency buffer within the range of say 5.5 to 6.5%. So this is the range required according to the Bimal Jalan committee, right? 5.5% to 6.5%. But shockingly, this is the upper limit, and this is what the RBI has kept as contingency reserve. So there is no question that has RBI compromised on the security of the banking system. No. So even after maintaining this maximum limit, upper limit of the required contingency buffer, which is at 6.5%, the board of directors or the central board of RBI has decided to transfer this much amount. Are you getting my point? So no compromise with contingency buffer as well as huge transfer to surplus. So win-win situation for both, for RBI, for government as well. We'll look into all these terms. What is the contingency buffer? What is Bimal Jalan committee? Everything else. So this is the news. Then here is a comparison that in financial year 2019, after the new economic capital framework. So in 2019, after the new economic capital framework, which was adopted by Bimal Jalan committee, after this suggestion, the RBI had transferred a surplus of 1.76 trillion. So the earlier was only 1.76 trillion, but now it has jumped substantially, right? So these provisions, these new transfers are on the basis of recommendation of a committee known as Bimal Jalan committee. You remember this name, okay? Very important name. So there are certain committees related to your banking system of India, like Narsimha committee, Bimal Jalan committee, PJ Nayak committee, right? Many else. But here our committee, which is relevant for us, and the news is related to which committee is Bimal Jalan committee. Who was Bimal Jalan, or who is Bimal Jalan? Tell me. Erstwhile or former governor of RBI, right? Bimal Jalan, you must be knowing, has been governor of RBI, okay? Yes, right? So this is your, according to the new economic capital framework adopted by Bimal Jalan committee in 2019. So this committee recommended a new economic capital framework. I'll make you understand what is this framework, what are the components, how has the surplus and this contingency percentage decided, everything else, right? So this economic capital framework devised a method to determine how much surplus the central bank should transfer to the government. So it is in accordance with all these things. There is no superfluous thing which has been talked about, right? It has been measured. It has a proper metric behind this decision. Are you getting my point? So what is this economic capital framework? Economic capital framework is the framework, or it is a method. It is a method which has decided that how much surplus of the central bank, the profit surplus of the central bank, should be transferred to the government of India. How much should you do that? See, this is something which has been in debates, right, for years. Sometimes there is a tussle or there is a war between RBI and the governor regarding transfer of surplus. So that's why this news becomes important, right? Okay. Now let's see what has happened so far. First of all, let's understand what is this Bimal Jalan committee and how the picture goes on, right? Bimal Jalan committee. So basically, Bimal Jalan, ex-RBI governor, former RBI governor, okay? The Reserve Bank of India, in consultation with central government, had constituted a committee chaired by Dr. Bimal Jalan. So who constituted this committee? Your RBI only, but in consultation with your government of India, right? Chaired by Bimal Jalan. That's why known as Bimal Jalan committee. Why this committee was constituted? To review the current economic capital framework. To review the current economic capital framework which was there. Okay, so it was constituted in 2018. It basically reviewed the economic capital framework. I'll tell you what is economic capital framework. Okay, so it reviewed the economic capital framework and tried to include something new and new suggestions beyond 2018. So then it gave recommendations in 2019, and then almost all recommendations of the committee were accepted by the RBI. Okay, submitted its report to RBI governor in 2019, and almost all recommendations were accepted. So this is introduction to your Bimal Jalan committee. Now let's see what has been talked about in this committee regarding economic capital framework. So this is something in news, in every news, every editorial. You need to understand what is this economic capital framework, on the basis of which the RBI decides how much surplus it needs to transfer to the government. So this becomes very important, right? Now let's see what is economic capital framework. What is economic capital framework? Okay, economic capital framework basically provides a methodology. So as I told you, it is a method through which it has been decided how to calculate everything, or how to decide how much surplus needs to be transferred. So it is a methodology for determining the appropriate level of risk provisions and profit distribution to be made under section 47 of RBI Act 1934. This is very important for you. So first thing which you should note here is that why RBI transfers surplus. Okay, why? Who requires the RBI to do this? First of all, you should make one thing very clear, that RBI has nothing to do with the Constitution of India, right? Every provision related to RBI is legal, not constitutional. Okay, so it is statutory, it is not constitution. This must be clear to you all. Okay, so whatever the provision is, whatever the RBI does, has to do with the RBI Act only, RBI Act of 1934, as you all know. And which section? Section 47. So section 47 of the RBI Act requires the RBI to distribute the profit. Did you get this point? So first question answered. What is the legal provision? Who requires this for the RBI to do that? Got this point? Section 47 of RBI Act 1934. Now, so this basically economic capital framework we were talking about. This economic capital framework is a methodology for determining the appropriate level of risk provisions as well. What all are the risk provisions? How the risk buffer should be maintained. Are you getting my point? And profit distribution. How much profit needs to be distributed? How much and in what manner, out of which funds the profit needs to be distributed to the government of India. So this is required under section 47 of RBI Act 1934. So this is your legal or statutory background. Getting my point? Now, as per section 47 of RBI Act 1934, clearly given here that central bank is required to pay balance of its profits, not entire profits, balance of its profits, so extra profits. Getting this point? So that is why this transfer is always known as surplus. Surplus means extra, over your requirement, in excess to your requirement. Everyone getting this, right? So section 47 of RBI Act 1934, as per this section, central bank is required to pay balance of its profits to the central government after making, but after what? After meeting some of the obligations. So you cannot do this that, okay, RBI has earned some profits, transferred directly to government of India. No, RBI is the banking sector regulator of India. It is the central bank of India. It has a lot of responsibilities and obligations to abide by. Are you getting my point? So in that case, you have to maintain something, and beyond that, you can transfer. So after making provision for what? After making provision for bad and doubtful debts, as you all know, NPA is a big problem. RBI has an active role to play in case of resolution of NPA. Yes, not more than forecasted extra income over your expenditure. Okay. So your every question will be answered in this PPT only. Just let me stick to all these points so that I can maintain the correlation between the points. You can ask me your doubts in the end of the session, okay? Because it is very technical. I need to explain everything to you and interrelate them as well. I would appreciate if you ask me doubts in the end of this session today. All right? Okay, so as per section 47 of the Act, central bank is required to pay balance of its profit after making provision for bad and doubtful debts. First thing, doubtful debts and bad debts, we all know, NPA, right? Then depreciation in assets. Whatever assets are there, There is something called depreciation as well. Depreciation is what? Decline in value of an asset over the period of time. So for example, you have a car, okay, you purchased it for say 10 lakhs. After a few years, it won't be of 10 lakhs. Are you getting my point? So depreciation is there. Similarly, in case of RBI assets, there is depreciation. So you have to maintain for that depreciation as well. Then contributions to the staff. You have to take care of your staff as well. You cannot directly transfer the profit or the surplus without taking care of your staff. So you have to make provisions firstly for bad debt, depreciation in assets and contributions to your staff. Then only you can think of transferring, and then you have to transfer. Don't think of, you have to transfer the balance of your profits to the Government of India as per section 47 of RBI Act 1934. Got this point? So moving ahead, okay. Now, so this was about Bimal Jalan committee and the economic capital framework. So now the question is, what did the committee say on risk capital framework for the central bank? What did the committee say? So you know, there is something called risk capital framework. Every bank, be it a commercial bank, be it a central bank, you need to maintain certain emergency reserves or contingency reserves, because this is the most important sector which can prevent you from any crisis in future, right? So there is some international comparison done by the Bimal Jalan committee over here. So this is what has been written. What did the committee say regarding risk capital framework of the central bank? Now, the committee observed that there is no internationally laid down risk capital framework for the central bank. If you all know, there is something called Basel framework, Basel norms. Do you know what are Basel norms? But they are not for the central bank, they are for the commercial banks. Are you getting my point? Yes or no? You know what are Basel norms? Basel 1, Basel 2, Basel 3, Basel provisions. Anyone? Yes, right? So there is something called Basel framework or Basel norms. Basel norms, yes, okay, very good. So you know about Basel norm, right? Fine. Basel norms provide capital adequacy ratio norms, okay, to commercial banks. So you need to maintain say 9% of capital adequacy ratio in the form of tier 1 and tier 2 capital. So this is something which we'll look into later, a proper concept, a detailed concept which we cannot talk about in this session, right? So it requires certain amount which is 9% at present in tier 1 and tier 2 capital for commercial banks, but there is no such provision for central bank of any nation. This is what I am trying to convey to you. Okay, yes, but it was revised to 9%, okay, later. So we'll not go in Basel norms. So we'll stick to this only. I am trying to say that such norms are not there for central bank. This is what the committee highlighted. But then what? Why do we require the central bank to keep certain buffer? Because different central banks develop and adapt different risk management. So it is up to the central bank of any economy. It is up to them. They devise their own framework for the risk management depending on their specific conditions and requirements. You all know that there are different macroeconomic conditions for each and every economy. So depending on those conditions, depending on the liquidity status of your banking system, everything else, the loopholes, the achievements, the risks involved, the credit creation, everything on the basis of your banking system, you decide it at your own, right? So this committee, Bimal Jalan committee, was of the view that financial resilience of the RBI must be maintained. So point here is that although there is no international norm to maintain this, but you need to maintain financial resilience of RBI, which has been witnessed in the previous years of a lot of setbacks, which has resulted to somewhat decline in many major central banks' performances, but RBI stood by all the odds. As you all know that RBI governor received an award as well. That is your current affairs thing. I would appreciate if you give me the answer. Okay, best governor award, which year? You must have read about this, right? So let me know which year. Okay, so the committee says that you need to maintain the financial resilience. Okay, good. Financial resilience of the RBI, okay, above the level of peer central banks. So the peer central banks like the Central Bank of say US, Federal Reserve, okay, and other central banks of major economies, of European Union, of China, and of Japan, and every other major economy, right? So among them, your resilience should be most higher. It should be noted that RBI's central banking economic capital, it should be noted that the RBI central banking economic capital stood at 26.8% of its balance sheet. 26.8% of its balance sheet, which is the 5th largest. So you cannot compromise on that. You cannot compromise on that. You need to maintain your banking economic capital. I'll explain everything to you. What is economic capital, right? So every term which falls under this presentation, under this category, will be explained. Don't worry, just stay focused, okay? So the committee, there is an information here that RBI's banking economic capital is 26.8% of its balance sheet, which is 5th largest. So you cannot compromise on it. Now the question is, what is economic capital of a central bank? So when we say that there is economic capital of a central bank, you know what is capital, right? But what all components are there in case of RBI's economic capital or RBI's central banking economic capital? RBI's central banking economic capital. Okay, so here is the explanation that economic capital of a central bank. So we are talking about economic capital of a central bank, not of a commercial bank. Getting my point? So economic capital of a central bank includes what? It includes capital, all your assets which fall under the category of capital. Okay, you know what is a capital? Capital is something which earns for you, which gives you earnings. Are you getting this or not? Your assets basically. So capital, then your reserves. You all know that RBI has reserves. Reserves of forex, reserves of securities, reserves of gold, all those kind of reserves. Domestic, foreign, right? So RBI has something called as reserves. Then risk provisions. Risk provisions. What you all need to maintain to avert any kind of risk. What are the risk provisions? Getting this point? And then there is something called revaluation balances. I'll explain what are revaluation balances. But other things are clear to you. I hope other things apart from revaluation balances are clear to you, right? Shall I proceed? So this is what economic capital of a central bank constitutes. So remember, you can remember them on tips. Capital, reserves, risk provisions, simple risk provisions, and then you have revaluation balances. I'll be coming to revaluation balances. Okay, so this is first thing, economic capital of a central bank. Now when we talk about risk provisions as well, so risk provisions are a part of central bank's economic capital, right? Just right now we have discussed. But what are these risk provisions? These also have broadly two categories or two components which you need to know. Okay, so risk provisions, when we say risk provisions, we actually mean the contingency fund or the buffer and the asset development fund, right? Contingency fund and the asset development fund. So what is contingency fund? First of all, contingency fund, it includes provisions for unforeseen contingency, as the name suggests. Simple. Contingency fund, fund for any unforeseen activity or phenomena. You cannot foresee everything which is going to happen in life, right? So arising from, say, depreciation of securities, you have securities, you have assets, so there can be depreciation. Okay, rather than gaining, you can have a loss. So to avert those or to manage those situations which are unforeseen, you need to have some contingency fund. Okay, say depreciation of securities or monetary and exchange rate policy risks. You all know that exchange rates, okay, and your monetary policy rates, everything involves risk. Are you getting my point? There is day-to-day fluctuation in exchange rate, which amounts to huge losses as well. Okay, therefore we have something called spot market, forward market, okay, hedging, everything else, but we cannot discuss them here. It's just that you should know that due to these risks, which you all know that they are there in the case of RBI, you need something called as contingency fund. Is this clear? So first component of your risk provisions, and risk provisions are your part of central bank's economic capital. So this is contingency fund. Then asset development fund, which is the amount set aside for investment in subsidiaries and internal capital expenditure. You need to do some capital expenditure as well. Okay, so RBI not only receives, it spends as well, and spending has two components. One is revenue expenditure and one is capital expenditure. So say you are paying your salaries, the exam which you are preparing for, RBI Grade B. Okay, so you'll receive salaries, but that is a part of revenue expenditure from the side of RBI to you. That does not create any asset to the RBI. You are just being paid a salary out of the RBI's fund. Getting my point? But there is something called capital expenditure which creates assets. So RBI also has to do that, to create assets so that it can earn more profits. So that falls under the category of asset development fund. Fund for development of asset and fund for emergency situations. They comprise the risk provisions. Got this point? Then we have something known as contingency risk buffer. Contingency risk buffer. This is very important. This is very important. The initial news, if you remember, in the initial slide, it was, I mentioned that RBI has maintained the upper limit of the recommendation of Bimal Jalan committee, which is 5.5 to 6.5. So upper limit is 6.5% should be kept. Yes, 6.5% should be kept in the form of contingency risk buffer. Contingency buffer. Right? So this is maintained at 6.5, and then this much amount has been decided to be transferred to the government of India. So what is this contingency buffer? It is basically the risk provisioning made from economic capital to cover monetary, fiscal stability, credit and operation risk. Okay. It is basically cumulatively referred to as the contingency risk buffer. So basically, contingency risk buffer or CRB is nothing but risk provisioning made from economic capital. Risk provisioning, you all know by now what is risk provisioning. So if someone asks you what is risk provisioning of RBI, you can answer that it includes contingency fund and asset development fund. Got this point? And this is a part of your economic capital of the central bank. Yes or no? So first thing, then risk provisioning made from your economic capital, as it is the part of economic capital to cover. Now why is this provision, or why is risk provision, or why contingency buffer is kept? To cover monetary, fiscal stability, credit and operation risk. Any kind of monetary risk can be there, monetary related to RBI. Any kind of fiscal risk can be there related to government policies. So finally you are accountable to the common man. Yes or no? Finally, our common aim is achieving economic growth and inclusive growth as well. So due to any monetary fiscal risk, to maintain that stability, credit related risk in the banking sector, right? Operational risks, you need operational capital as well. So you need to have that much amount as well, that much buffer to run your business, right? In order to maintain all these things, you need to have something called as a buffer, as an emergency fund, which is known as your contingent risk buffer. Now is it clear to you all what is that 6.5% which is kept by the RBI and all these components which we have discussed so far? Yes or no? Just let me know so that I can proceed further. Yes? Okay. Alright. So this is your CRB, contingency risk buffer. Alright. Now moving ahead. So we have seen different terms so far. In bank's economic capital, central bank's economic capital, what was all there? The capital, the reserves, the risk provisions and the revaluation balances. So I told you I will be coming to revaluation balances. Now what are these revaluation balances? There is a particular recommendation of the committee regarding this as well. Okay. So your revaluation balances are unrealized gains. Revaluation balances which form an integral part of your central bank's economic capital are basically unrealized gains and net losses of the RBI. What are unrealized gains? Does anyone know what is an unrealized gain? So unrealized gain is basically a profit on the paper. Okay. Suppose the price of your securities has increased, but you have not realized it, you have not sold that. So the profit will be said to be realized only when you sell that asset. Then only you can have the capital gain. Are you getting my point? Yes or no? So unless it is on the paper only, it is known as unrealized gains. Profit is there, but only on the paper, not in actual monetary value. Is this clear? Okay. So revaluation balances are basically your RBI's, not yours, RBI's unrealized gains, net losses resulting from, say, movement of exchange rates, gold prices, interest rates. Why does RBI has? Yes, yet to be encashed. Why RBI has all these kind of losses or risks? Because they are dealing in a very volatile market. Exchange rate, most volatile thing you can have, right? Then gold prices, volatile. Interest rates, volatile. All these things are volatile. They keep on changing. That's why there are unrealized gains as well sometimes. Sometimes you have capital gains and there are sometimes net losses as well. Is this clear? So this is known as revaluation balances, and remember, I'll be coming to it later again, and I'm telling you, you note this point, that this is the most volatile part of your central bank's economic capital. Are you getting my point? Revaluation balances is the most volatile part of your central bank's economic capital. I'll come to this point later and then I'll ask you. Okay. So this is. Now there is just an information for you that revaluation balances are major component of RBI's economic capital. So presently it is almost 73%, and so you can see that economic capital of RBI is volatile. You can say that because more than the half, the majority is in the form of revaluation balances. Yes or no? So we can say that majority of the part of economic capital of RBI is volatile, isn't it? Do you agree with me? No one agrees? Or do you agree with me? Just let me know. Yes. Okay. Thanks. Then realized equity. Now there is something called realized equity. This is very important because it is directly related to your news. How is it directly related to the news? I'll make you understand. Okay. So first let's understand what is realized equity. Then I'll explain how is it related to Bimal Jalan committee's recommendation. So it is basically component of RBI's economic capital. So we have seen that there is economic capital of the central bank. Okay. Economic capital of the central bank, in which we have capital, we have reserves, we have risk provisions, and we have revaluation balances. So when you keep aside the revaluation balances, other three things are known as the realized equity. Are you getting this point? Apart from revaluation balances, all other parts of your central bank's economic capital fall under the category of realized equity. Why? Why realized? Because this is unrealized. Simple. Isn't it? The revaluation balances forms a major part as unrealized equity, which is unrealized. So every other thing which is realized, like capital, like reserves, so there you have realized that amount, right? You have encashed that, comes as realized equity. So it is less volatile because it has been realized, okay, not to be realized. Then it is the component of RBI's economic capital comprising capital, reserve fund, and risk provisions. Similar things as that of the economic capital. It's just that the revaluation balances do not form part of it. So you have broadly two categories as part of your central bank's economic capital: the revaluation balances and the realized equity. This is what the committee has talked about broadly. That's why I'm emphasizing more upon these two terms, right? So your revaluation balances kept aside forms your realized equity. Okay, then is this difference clear to you all? The difference between revaluation balance and realized equity? Yes, very good. So then we have something about the committee. So it has suggested, the Bimal Jalan committee has suggested that a distinction needs to be made. So I am not making the distinction for my sake or for your sake. Okay, this distinction has been required to be made by the committee only, by the Bimal Jalan committee only. Okay, needs to be made between realized equity and revaluation balances in RBI's balance sheet. So it requires RBI to maintain this distinction. Why? I'll be coming to that, as the latter are highly volatile. Did I tell you recently that, remember, these are the most volatile items in the economic capital part? Yes or no? Right? So you note it down that why this distinction has been made by Bimal Jalan committee. It can be asked in detail in your descriptive part as well. So because revaluation balances are highly volatile, while the realized equity is not. So you need to maintain this distinction, and then you need to decide out of which you are keeping the contingency reserve buffer. So this is why I have explained you the entire story. Getting my point? So this is first thing. Then it also recommended that RBI should also include its revaluation balance as part of overall risk buffer. RBI should include revaluation balances as part of its overall buffer. However, that should be made as a part of your overall risk buffer which you are keeping. But there is something that, however, given their volatility, we have discussed recently that they are highly volatile, the revaluation balances, because it is unrealized gains, right? Given their volatility, these balances should be treated as limited purpose risk buffer. So remember this, limited purpose risk buffer. Getting my point? So this is another major recommendation, and on basis of all these things, RBI has taken this decision yesterday. So you need to understand the big picture, right? So committee has said that although you should include revaluation balances as part of your overall risk buffer, but that should be kept as only limited part. You should not rely heavily on revaluation balances since they are highly volatile. Everyone clear about this? Okay? Because they are volatile. Something which has risk in itself cannot be relied upon in case of risk. Are you getting this? Something which has risk involved in itself cannot be relied heavily to maintain your risk buffer. Okay, so that is the thing regarding committee. And now, so the current surplus distribution policy which we have seen beyond 2019, after 2019, targets only the total economic capital. The committee recommended that target should also include realized capital. So that's why in the recent economic capital framework which we have discussed earlier, the entire methodology of calculating how to distribute this thing. Okay, so out of that, beyond 2019 when this recommendation was given and accepted, since then the current surplus distribution policy of RBI targets only total economic capital. So it targets the total economic capital, which means it has revaluation balances as well and the realized equity as well. But the committee has recommended that the target should also include realized equity particularly. So there is high focus on realized equity by the committee. That's why it has been highlighted here. Realized equity. Okay. And the committee has said, Bimal Jalan committee has said that the size of realized equity in the form of CRB. So your CRB is nothing but your realized equity. Is this clear to you all now? That what is the contingency reserve buffer which everyone talks about, but you don't understand what actually does it constitute. So are you able to understand it right now? That committee has said that the size of your realized equity in the form of CRB must be maintained between 5.5 to 6.5 of RBI's balance sheet. So this is how you link the recommendation. So this is the upper limit and this has been kept by RBI. Did you get this point? So what is your contingency reserve buffer? It is your realized equity only. So heavy focus on realized equity as a form of CRB should be kept 5.5 to 6.5 between this range, okay. So a range has been provided of the RBI's balance sheet. Out of what? Of the entire balance sheet of RBI, assets, liabilities and many other things, right? So this is the major recommendation and this is your CRB, more focus on realized equity. And then the total economic capital. What about the target of total economic capital? CRB and realized equity is just a part. We have everything else like the revaluation balances, okay. So what about the total economic capital? So the committee has recommended that the total economic capital should be maintained between 20.8% to 25.4% of the balance sheet. So this percentage is of what percent? Percentage of the balance sheet of RBI. Percentage of the balance sheet of RBI 20.8 से लेके 25.4% of the balance sheet. So this is your CRB. Then the committee says that if the realized equity is above the required levels, which means that the CRB is above the required levels, okay, above the required levels, above this level 6.5%. Okay, then the entire net income of RBI will be transferred to the government net. Okay, so everything beyond your expenditure, entire can be transferred to the government. If your realized, this is very important, remember. So the committee has said if your realized equity is above the required levels, which is from 5.5 to 6.5%, the entire net income of the RBI can be transferred to the government. But what if the other is the case? If it is lower than this range, risk provisioning will be made. How much you need to keep aside for your risk and contingency and all, and then risk provisioning will be made to necessary extent, and only the residual net income will be transferred. So in that case, only the residual net income will get transferred to Government of India. So no compromise with RBI's risk resilience, RBI's resilience. Are you getting my point? So no compromise with RBI's position and resilience. So what the committee has said, if you have more than the required realized equity, transfer the entire net income, okay, entire surplus. But if your required realized equity or CRB is below the required level, then you need to do some risk assessment and risk provisioning, keep aside certain funds, okay, because you have to maintain it for future emergencies, and then the residual net income can be transferred to the Government of India. So this is actually the entire picture, and this framework may be reviewed every 5 years. So since 2019 it has been going on. So it can be reviewed every 5 years because things change, okay. The provisioning, the macroeconomic conditions of India, RBI's assets, capital quality and numbers, everything changes, right. So that can be revised, but till then this is your guideline given by Bimal Jalan committee, and that is the news. Now coming back, or say discussing back the headline, RBI decided to transfer 2.1 trillion rupees to Government of India. So this is your surplus transfer even after maintaining 6.5% of CRB, contingency reserve buffer. Now these are the 2 points, and there is entire story in between. I hope, just let me know, I hope you all have understood the entire thing, each and every aspect which is there. Yes or no? Is this news entirely clear to you now? Any question asked in any depth or detail will be very easy for you now to answer. Understood? Yes? Yes, okay. So this is regarding this news, okay? All right, very good. Bilingual, okay, perhaps would have understood it more better. Okay, I'll consider this point, okay, and I'll consider this and we'll try to include this suggestion, okay, regarding bilingual lecture. All right, otherwise if there is any problem regarding any word or something, you can ask me in the class as well. Okay, it's just that sometimes when you have such a technical analysis, you know, everything is related to one and other, I need focus to make you understand everything in a chain. That's why sometimes I ask you to ask in the end, ask your doubts in the end. Otherwise you can ask in between as well. Okay, all right. So this is your major news. You are now well equipped with any part of this news. Okay, you can discuss it with your friends and prepare for the examination. Now moving on to the other editorial which I have picked up. Yes. Okay, so you need not thank me for this session, it's my duty. Okay, I just want you to have a very deep understanding of all these things which are going on. Okay, so all right, this was your news, and okay, it is not over yet. It is not over yet. Sorry. Okay. Yeah, I have extra for you, something extra for you which I have included. No, the session is not over. Stay tuned. We have done the technical part, but there is something to be discussed yet. So basically, let's discuss. There are 1 or 2 slides more. Okay. What led to such huge economic capital and profits? So the question here is, just try to think that why RBI has been able to realize such huge profits. There have been some reasons behind that. So you must know the reasons as well, right? So according to some economists, there is facts and data getting every day in the newspapers. So economists say that there are large surplus because there is higher income in financial year 2024. So RBI has earned more. How did RBI earn more? Both from domestic and foreign assets. So RBI has earned from its domestic assets as well and from its foreign assets as well. That's why it is able to transfer to the government of India this much amount. Got this point? Now the question is it a windfall for government? Is it an unexpected gain for the government? How would it benefit the government? It is a very big news for the government. Why? See, because it is expected to give the next government fiscal space and greater elbow for expenditure management. Fiscal space, nothing. Fiscal means government and taxation. You all know that government is running into higher fiscal deficit, almost 5.9%. Yes or no? We have discussed it, right? So if you gain something unexpectedly, and that is not an obligation for you to repay, right? It is your earning only, that would help government of India reduce the fiscal deficit. So first thing the government can do out of it is reduce the fiscal deficit. Other thing, increase capital expenditure, because when you increase your capital expenditure, you need capital to do that. And when you invest as capital expenditure, that makes money for you in future. For example, your investment projects. Are you getting my point? So government has a win-win situation in this case. Okay, this dividend transfer is well above the budgeted figure. Now this is what I was talking about, that the figure which government expected in this year's interim budget was only 1.02 trillion. Only 1.02 trillion which government expected, combining RBI's dividend and dividend from other financial institutes or PSUs. So see how substantial it is. Government expected that okay, at max we can have 1.02 trillion rupees as dividend from RBI plus from other financial institutes, but this is 2.11 from RBI itself, right? And which includes dividends from both RBI financial institutions, but it is something very beyond that. So overall, this decision would help in fiscal consolidation. There is a term called fiscal consolidation, which we have discussed in earlier analysis, that when government tries to reduce the fiscal deficit, improve its earnings in order to improve more government expenditure, to incur more government expenditure, right? So a prudent fiscal policy where you try to reduce the deficit as well and do not compromise on your part, on your duty, which is your expenditure, right? That is known as fiscal consolidation. So that decision would directly help in fiscal consolidation of the government of India. Yes. Okay. So I hope this is done now. Yes. Okay. So now it is completed. This was just an analysis of the news for you. Okay. You should know the background and the benefits, if there are any, of the situation as well. Okay. This profit is for 24 financial year 24. Okay. Now I have another editorial as well, just a brief discussion about it. Today every newspaper is flooded with the news of RBI dividend only, right? But there was something in Economic Times regarding one more achievement in case of India on part of India, which is market capitalization. So that is also important. We cannot ignore other news. Okay. So that's why I have picked this article from your Economic Times. You can go and refer to this. Okay. So the news is increase in India's market capitalization, a huge achievement for Indian stock market. What is it? It says, the author says that India has achieved a significant milestone with its market capitalization crossing $5 trillion mark. $5 trillion, you can imagine. It has become the 5th largest stock market of the world. 5 trillion on Tuesday, okay, tripling in a decade, and due to many economic reforms and progresses. So, $5 trillion of market capitalization. $5 trillion of market capitalization. If I remember, yes, number of outstanding shares into price of each share. Number of outstanding shares into price of each shares is market capitalization. I have given you the formula in the next slide only. So don't get worried about anything. I will never leave you without understanding any of the concept written over here. Okay. Started. Is there? What is your question, Aditya? Okay, just write it down properly so that I can understand. First, let me focus on this news that it is an achievement for India, for Indian stock markets, for investors, domestic investors, that market capitalization in India has been how much, or it is crossing basically this mark even, $5 trillion, and 5th largest to do so, right? Now, why is this an achievement? If you remember, in the previous editorial analysis, there was something known as one editorial which we have discussed in the earlier classes, that FII has been pulling out from India, right? But that is not a concern for us. That is an achievement because Indian investors are increasing their confidence in Indian market. Next government, okay? Because elections result is to be there, so this dividend is for the next government. Clearly for the next government, okay? Yes, strong domestic support, very good. So this is an achievement, and why the editorial basically talks about why this has been the picture, because you know the foreign institutional ownership has although fallen, but domestic institutional investment has increased. You all know that. We have discussed it in the earlier editorial analysis as well. Yes, Abhi, you know that there is election result to be declared. So next government, definitely, okay. Then small investors typically participating through mutual funds have also increased their ownership in the market. Then you have, for the first time, domestic investors have gained a large share. This is a news which we have discussed in earlier editorial analysis, that why FII are pulling out their funds from India. Is this a concern for us? No. Our domestic investors are investing more, and particularly the middle class, as I have discussed with you, has fallen in love with the SIPs, systematic investment plans, right? So these things we have discussed, okay. Then the author has also given credit to certain structural reforms in India, like the GST, goods and services tax. I have already done GST in detail for you in one of the editorial analysis, right? Then we have IBC, Insolvency and Bankruptcy Code, the entire code of 2016, which tries to eliminate the address the problem of NPA, bad loans in India. Then we have technical advancements as well. Technology has credit every time, right? Then we have infrastructure development. Then our youth has also been participating actively in the stock market. Okay. Then favorable investment climates. Favorable investment climates. Since India has been resilient in all these back years, when you have El Nino effect, you have something known as Ukrainian war, you have had COVID-19, you were very resilient as compared to other economies. So that has boosted investors' sentiment into your economy. These are some of the reasons that you are able to increase your market capitalization. Now the question is, what is market capitalization? Market capitalization is basically the total value of a company's shares of stock. Okay, total value of a company's shares of stock. Now, for example, if a company has issued 10 million shares, it's just for example, so that you can clearly understand what do we mean by market capitalization. So, more the market capitalization, more your company in stock market has influence. Okay, suppose a company has issued 10 million shares and its share price is $100, which means price of each share is $100. So its market cap, in short, it is known as MCAP as well. In short, it is also known as MCAP, market capitalization. It is $1 billion. It is $1 billion. So yes, total outstanding shares. Outstanding share means which are held by the shareholders. Shares of the company held by the shareholders, all the shareholders, private, public, anyone. Okay, so total outstanding shares of the company, into all the outstanding shares into price of each share, gives you the value of your market capitalization. Is that clear to you all now? So this is the news and this is the concept of market capitalization. Is this clear to everyone? Yes? Let me know quickly so that I can wind this session. Yes? Alright. So I hope there are no big queries as such. I have addressed all of your questions so far, right? And that is it today for today's editorial analysis. And I hope this session was very useful for you, and actually it is useful. So just understand everything, and if you must have taken screenshots, otherwise you will get the PDF in the Telegram group. Okay, so that is it for today. I'll see you in the next session, and thank you till then. Good luck. Have a very great day. Thank you so much.